quite fortunate today to have Stephen Hart, Luton, who has both an engineering and environmental science degree, as well as experience in banking. He's worked over 18 years at the European Investment Bank, where he currently leads an advisory for nature. He's also served as the focal point for the Natural Capital Financing Facility up to 2022. The format today is as usual, the presentation roughly is 20 minutes, could run longer. Please put any questions you have in the chat. I will be recording them in order and will call on you in order when the question period starts. If you haven't written in the chat at any time, please raise your hand. I'll try to recognize everyone in order so we can proceed. So that said, and I will announce another webinar in December at the end. Thank you very much for joining us, Stephen. The floor is yours.
Okay, hello everyone. It's a great pleasure to be here. I just checked the names of the webinar. I know a couple of you, so hello to those who know me. So what I'll do is I'll try to project my presentation. Before I launch into this, so the background for this presentation is actually a report that we prepared at EIB, really to look at, you might say, the state of play around nature-based solutions financing in Europe. And it built on really our own experiences, but also substantial surveys. So it's a kind of snapshot in time. One of the motivators was, of course, that NBS, nature-based solutions, now figure heavily in a lot of European Union policies, which was the pretext, you might say, for asking us to prepare this report. But there wasn't maybe another agenda here, which was, you do hear a lot about finance and nature and natural capital. And if you go onto your LinkedIn feed, you get the impression that the world is awash with capital, just waiting to be spent on nature as a new asset class. And you hear these words. We suspected that perhaps others were finding the same challenges that we were. So this was an opportunity really to dissect landscape by landscape, how things were playing out. Anyhow, I shall see if I can present. All right, can you see that?
Looks good.
Excellent. So this is said report. So we went out and we did an enormous survey exercise. With all surveys, the response rate is always, a bone of contention. But nevertheless, I think we got about 1 in 5 of the respondents responded. We managed to do substantial interviews with all potential stakeholders in this, asset managers, project developers, public sector bodies. We also dipped into the European Commission Horizon project databases and other database of projects related to MBS, really to look at sources of finance, how they played out. And really just to fast track what the main conclusions of all this work really were. First of all, today, private finance or private source of capital are really very small. They're a very small part of the overall picture. Most of the funding going into nature projects or MBS projects are from public sources. That's EU and national funds. Maybe that's not a huge surprise, but then again, if you go onto your LinkedIn feed, you might get a slightly different impression. So it was important to just get this stated in black and white, really, on the basis of our discussions. Another thing that also corroborated pretty much our own experience is that project sizes in this space are small. In fact, when in our survey of these databases, the average project size was below 2 million. In fact, in our own experience, as I'll discuss a bit later, most of the projects that we encountered were much smaller than that even. Why is this important? If you're trying to match the world of nature with the world of finance, you find that most finances are looking for something much larger. They need scale. It has to do with economies of scale of the operations. It has to do with the transaction costs of dealing with projects that really you need to be above 10 million in project size for this to be viable for mainstream finances. Another interesting finding was that there is actually one landscape type in Europe which already benefits and in a way is projected to benefit from significantly more in relation to nature, which is agriculture. So none of the other kind of landscapes, for example, um, urban areas or marine landscapes or seascapes, forests, wetlands, really have much by way of a dedicated funding source for nature-related investments, but agriculture does. The only thing is that um, it's not measured very well, and in fact, the effectiveness of that funding going into agriculture is really quite questionable. In general, surveying how people have financed their projects, there's just a huge diversity, and that really does reflect the very local nature of nature projects. So some are very collaborative, other are more standalone, other more commercial. So you see quite a diversity in say financial techniques that are being used. Indeed, in most sectors, there isn't really a natural profit motive to be found, but there are a couple of exceptions, you might say. Not so much in terms of profit, but at least in terms of their ability to internalize, say, the benefits coming from working with nature. And it comes down to whether or not they have a matching time frame, i.e., a fairly long term in their thinking, but also have a footprint that is substantial enough, really, to accumulate enough benefit, you might say, um, to have a financial impact. And those two sectors are pretty much the water sector in all its forms and forestry. If we read the report, it goes through landscape by landscape, and it effectively presents type projects in those landscapes. Here's a marine one, and what it illustrates or tries to illustrate is that you have the cost side, what it costs for the upfront measures. It could be construction, it could be other things, even land acquisition for that matter. You have the maintenance costs associated with these projects. These are the cost side, and then you have the benefit side. And really, the central message is that even though cumulatively the benefits here, the blue on the right side, might exceed the costs, usually only few of those benefits are easily monetizable, which effectively is one of the reasons why these projects don't happen, out of private financial volition, if you will. I say NBS, nature-based solutions. In fact, when we looked at the potential in the different landscapes for NBS, it is very closely related to the full restoration potential in those landscapes, if you really want to find an upper figure. So this is specifically about, can we get private investors to invest in nature-based solutions while they will capture some of those benefits coming back, but many of those benefits are in fact shared with others. And as I said, not so easily monetizable. Also, a very important part of this report is a summary of our lessons under the Natural Capital Financing Facility. Now, this was a cooperation between the European Commission and EIB to test the notion of repayable finance for nature. And what it did, it really allowed us to provide equity financing, but also debt financing down to, say, project sizes that were not normal for the bank. It also had a technical assistance envelope to help with, say, project development, transaction costs, monitoring costs. Now, it ran for about 7 years. We ended up with 11, say, signed projects. It had to be extended. It was a very, very difficult mandate, in fact. Not that that really came as a big surprise. Um, the idea was to test something rather difficult in the nature space that is not, profitable. Um, but what really played a bit of a curveball was that projects were so small. So it was actually very difficult to get to high volumes. But nevertheless, it produced, these are 8 of the 11, a wide range of examples of different kind of business models, revenue models, benefit stream models. And the financial techniques ranged really from almost hardcore project finance techniques as we know them from PPPs with SPVs and a blend of equity and debt, to more public sector type operations, to working with equity funds, both with straight equity, but also through lending. We also experimented with loans that are the repayment of which is contingent, you might say, on certain revenues. So it's like an equity-like form of debt. So from that point of view, it was hugely instructive, actually, and will guide us in the future. So this kind of captures really the challenges here. So we screened, well, at least 150, probably more closer to 200. And in the end, we produced 11 signatures. Now, if you were talking to a venture capital fund, this would be perfectly normal. And it's worth highlighting that the NCFF that we ran as a pilot was a pilot operating on market terms. It wasn't concessional, so it wasn't subsidized. It wasn't cheap money in any sense. But we had a higher risk mandate, so we could go into more risky projects. But as such, the pricing was, well, follow similar principles to how a bank would, a commercial bank would approach it. So this was a very high bar to set in a sector that was used to grants. Now, so the very fact that we even managed to sign 11, I think, is an interesting testament to the fact that certainly from the beginning of the mandate in 12 until actually at the top, that's not correct. That's to 2021, not 15. It ran for 7 years. The idea was that if we follow these commercial principles, then this would act as a signal to other private investors who would then follow. That was the theory. To a certain extent, we certainly did the job in finding projects, but what we also have to conclude at this stage is that the market as such, or the markets that would run with these ideas, really are not fully developed yet. So yes, projects are very, very small. Some of them just, below 100,000 euros. In general, nature has a very low capital intensity. If you ignore the purchase of land, then planting saplings or seeds or clearing brush is not terribly expensive compared to pouring concrete, which is good on one hand, but of course it does mean that in terms of trying to engage the finance sector, which needs scale, you have a challenge. The bane of many of these projects were that they really needed money to buy land, and this is quite normal, in nature restoration. But IFIs like EIB generally have an aversion to financing land acquisition for a number of reasons that I'll discuss a bit later. Of course, many of these projects really didn't have any track record, and there are few experts or teams who have experience in this kind of say commercial working with nature. This has improved, I have to say, since we began. I mean, as we speak now, many of the NGOs who are operating in the nature sector have hired finance experts. They become much more financially literate. And so in general, we're finding it easier to have these conversations with promoters, but also civil society around repayable, say, semi-commercial concepts. Basically, the two ways we tried to deal with the fact that projects are small. One would be that you have, say, sheer aggregation, where for example, a particular promoter has several projects that they can put together into one program and seek a larger financing for those. That can also be banks, for example, who lend to multiple beneficiaries. So one of our operations was with Rewilding Europe Capital. Really, it was based on a loan from the NCFF. And what they will do is they borrow from us, and then they divvy up the money, as it were, and then lend to smaller projects. The challenge there, of course, is that this is a very complex area, so the transaction costs for aggregators and intermediaries can be very, very high. It's very difficult for them to actually meet their own costs, and this was a major lesson, really, that there are very few market players out there who can play that role. And it almost speaks to the fact that you need to create, from the policy side, a dedicated instrument to deal with this very varied group of small projects and small enterprises. Then there was mainstreaming, which was, we did discover that nature was often found as part of larger strategies. So, investment programs might have a component which was 2 or 5% around biodiversity. What was interesting was that very often they wanted to have a conversation about that, to improve it or to enlarge it, to demonstrate the impact much better. There's a lot of interest in creating visibility about biodiversity as incorporated in larger programs that we could build on. So if you actually go into the theory of this, many of the barriers that we hear about are fairly well known, which is, well, people don't know enough about biodiversity, or it's hard to measure, or coordination issues. It can be, collectively, different stakeholders would, in their own interests, maybe implement a project, say, in terms of restoration, but in a way they can't find a way of working together. It's very difficult to build those intermediary steps to creating that collective action. Risk plays a role, but not as much as just the sheer lack of revenues, actually. And then, of course, the transaction costs and long time frames. But even if you put away with all those, you're still faced with this fundamental issue that when you do something for nature, you can't keep it for yourself, effectively, which yields this whole public goods question and how to remunerate that into question. And then what is a particular challenge also is that while one might want to restore and create some kind of a benefit stream by restoring nature, in fact, very often you're trying to deal with damage created by other sectors. So these are externalities, in a way, spilling over from other sectors into the nature sector. So, and if you really cut it down to the essentials, when will a private investor go ahead with the project? Well, basically, when the benefits are larger than the costs. And the thing is, if the benefits are just €1 short of the costs, then in fact many of these projects just won't happen. And this is also one of the reasons why we just don't have these functional markets. Now, markets are a complex, a bit of a complex concept, but fundamentally you can create markets through regulation, for example. And we know some, some of the international carbon offset markets. So there, the voluntary market exists in some fashion, also partly driven by regulation. Of course, co-financing, literally bridging that gap, that shortfall between the benefits and the costs. That's also one way of addressing it with subsidies, though not a particularly sustainable one, because eventually you do run out of subsidies. Um, and you have to also sometimes question how useful markets are in reconstructing, say, meaningful nature restoration. I mean, what is nature ultimately? You know, when you look at flyways for birds, for example, um, or you look at the effects of vegetation on hills in Germany, on flooding in Belgium, all these things are very particular, and you know, nature has evolved over millions of years. Um, Markets are not an invisible hand that grows nature as such. It's probably much better suited for reducing pressures, for example. Not that market instruments can't be used in a useful way, but there will always be the need for some kind of a bit of a blueprint there. And the main issue facing many ventures into, say, large-scale restoration in Europe is simply the inability to put together coherent land. And behind that, you have some very, say, difficult vested interests like agriculture. Don't have to expound on that, but this is so central that if large-scale restoration projects are not addressing this, or strategies are not addressing land, they will not be particularly relevant, to be honest. So one of the reasons why land or land acquisition is deemed difficult for investors, or say public investors. Private investors have no problem with this, by the way, but from the public side, is that there's an additionality question around it, because when people finance something, they like to think that they're changing something, and mere acquisition of land is not really considered to be an intervention. So it's very, the theory of change is kind of off here in relation to conservation and restoration. And then, of course, you have all the sensitivities. Most people engaged in land restoration run the risk really of well, in some cases, quite a lot of attacks from vested interests, even before they manage to acquire the land. But land is nevertheless the key issue very often, and ideally we wouldn't have to buy land, because it is terribly expensive and can simply drive out. It can use up all your funding and also drive out the profitability for investors. But there are so many places where it's the only safe option really to protect something is to own it. And say leasing models and easement models, as we know them from the US, are not like particularly well developed in Europe, and that is certainly an area really that would deserve to be developed more. Just to look at some numbers here. If you look at what the nature restoration law in Europe would imply in terms of costs, there's a number from 2022, 154 billion. Now that is most likely a low figure, not least because it assumes that these actions can be conducted without a change of ownership, and change of ownership will require some kind of financing too. But to put that in perspective, if you actually look at what, say, Europeans spend on their water bills, and what is actually spent on say capex and maintenance for the regulated sector of water and wastewater, it's about 100 billion per year. And really what that's telling us is that it's regulation that really can unlock the kind of numbers that we need for full-scale restoration. And in fact, there are some, as I mentioned before, agriculture actually receives quite a lot of funding for nature-related purposes. In fact, in the previous MFF, it was about 9 billion per year, and that's gradually increasing. And in fact, that is a significant amount in relation to the needs, in fact, on agricultural lands in terms of restoration. So in some cases, the money is actually already there. It's just not being, say, monitored or spent very effectively, you can say. Now, I mentioned this thing about land transactions. I mean, this land acquisition is actually a heavy item in the budget. And if you take 20% of EU terrestrial area, which is supposed to be under restoration under the nature restoration law, you arrive at something of 85 million hectares. Now, naturally, not all of that requires acquisition. Some of this is, a lot of it is already protected areas, is already publicly owned land. But this is easily also in the tens of billions, actually, to add on to the 154, which is really quite low. Really, in the absence of these markets, which in other sectors like infrastructure or innovation really emerge through say, private investors who start specializing really along their different time horizons, for example, and risk appetites. Without this underlying market driver, the market will not organize, you might say, these separate stages of financing that we also need to take nature projects from early ideas to something that's slightly scaled up growth, and eventually something which is commercial, you might say. And where the greatest need is really in the early stages. So out of the 150, the 140 that we didn't finance were typically small and risky and too innovative, really, for normal bank financing. And really, that is so. If there's one thing anyone can agree on in this space, it's actually is that we need some kind of an accelerator early stage financing instrument in Europe. There's also another feature. I mean, competition between repayable financing and grants can be a challenge. It disrupts the deal flow very often for the repayable financing instrument. And the only real way of solving this in a sector that really is not ready to leave subsidies and grants behind is have a much closer cooperation between the non-repayable and repayable source of finance. Basically, there's a continued need for this concessionality, but above all, better coordination. I just want to unpick a few terms here because maybe I can contribute to cutting a bit of intuition. You often hear people talking about, we have an investor. And in fact, it turns out it's some philanthropic grant. And you often have this tendency that people have a difficulty in discerning between what is real, say, financing and what is effectively just a present, a gift. And in fact, a lot of the language that's imported from other commercial sectors into the nature sector makes this even more confusing. But in our, say, bank world, we really distinguish between what is funding, which is basically the revenues, the benefits, but also be taxes, and the financing, which is a tool really that provides the liquidity pretty much upfront to build things, and then it gets repaid later. And areas like, say, adaptation, nature, and other areas with high externalities, this public good aspect, are primarily a funding challenge, not so much a challenge in terms of financial structuring, though that is also an issue. But ultimately, that the main area of intervention here is to convince somebody to pay for it. So this willingness to pay question, and within Europe, affordability is not so much of an issue. There are plenty of very large projects that have got off the ground and nobody complained. But these projects, either because they were mandatory, for example, the Thames Tideway Tunnel, 4 billion sewer, or the Emscher Canal restoration, about 3 billion euros. that was really through massive investment in talking to citizens and building a coalition between, say, the population and businesses and so on and so on. So when we're going out and we're trying to identify what problem we're trying to solve, it's really the funding side that you need. Where is the money coming from that might repay a loan? The private financing is not some magic alternative universe source of money. In the end, it's you and me repaying this stuff. Taxes are not a magical, it's you and me. It's the funding side that is the ultimate source of payment for projects. No doubt you would have heard about blended finance as a solution to some of these problems. And indeed, when we add a subsidy or grant element, that's a kind of blending. Or we can introduce guarantees to reduce the risk, for example. It's interesting to look when you unpack these things. Ultimately, blending arrangements consist of a range of stakeholders. So, for example, you can have a public entity. It can be the EU, for example, who wishes to say provide protection to private investors to reduce their risk. But that is never free. There's always going to be a very strong policy ask there. And in fact, a lot of sources of guarantees, from the public side, want control and also sometimes like to interfere a bit. Well, the private side doesn't want any public, say, intervention in investment decisions. What they want is something that is very profit minded, or at least follows commercial principles without any form of interference in investment decisions. So it's actually fundamentally a rather uneasy marriage. And in fact, in some cases, private investors will even be discouraged from strategies that get this kind of protection, because the underlying message is that this is actually a risky proposition. Then you have other actors like EIB who come into the picture, who can talk to both sides. So the private side pretty much appreciate that we can take care of people's money, and the policy side recognize that we're a public institution, and therefore we are literate in policy and impact and the whole way of thinking. Then you have philanthropists who might be happy to say protect the private investors, but definitely not in any way subsidize their profits, for example. Or impact investors who are looking for a slightly different risk return. So, for example, mainstream finance follows some pretty square principles in terms of markets, pricing, and so on and so on, and risk assessment. They can be very, very risk averse. They don't particularly want to get involved or do any hard work. They're actually a very tough crowd. And yet, and I think this is a bit of a mistake, many say impact seeking, or many projects looking for financing, look at the world of capital markets and they see all this money sloshing around and they say, well, if only 1% of that came our way. It is fundamentally disinterested in things exotic. You'll be talking to a wall half the time if you go to institutionals around the kind of things that we're trying to do here. But impact investors are a different creed. They are actually trying to make things work. They're not simply trying to put money where there's least risk, or simply easier ways of making money. Just to say that behind all these techniques, it's just the more basic phenomenon that all these blending arrangements, or blended finance, are still a partnership of stakeholders with different interests, and to create them often requires people who have the skills and the language, to speak to both sides. In fact, one of the interesting, say, propositions that's made to philanthropic organizations is that, why give a grant where you can invest instead? Truth is, many philanthropic organizations are divided into the money making people and the money spending people, and the money spending people have nothing to do with money making. So you can be talking to one end of the organization, and really they're not interested in getting into say financial engineering, and there is an economic logic to this, because frankly, if they wanted to make money, they will probably make more money on their, say, their shares, and with that money they could just simply transfer more grant back to the money spending people. There's actually a sound economic rationale to the fact that many of these philanthropics don't particularly want to get involved in say repayable constellations. Some do, and there's a culture change, but many don't. It was just interesting maybe to look at some examples of business models. So I've picked out a few from forestry and from water. These were the sectors that I mentioned at the beginning that have some kind of natural alignment. So here are three that we managed to finance with the NCFF. So the first one is a French forestry developer. And what they do is they buy up mature forests, but that have been rather poorly managed. And they perform, say, the first, say, introductory cleaning operations, the thinning out perhaps, improve access inside, and so on, and revalue these forests after acquisition. And so what their revenues are ultimately based, or the revenues from those forests are ultimately based on, say, picking select high value timber specimens, as it were. Not maybe they leave 3/4 of the tree standing, say, and they're excellent foresters. They understand hydrology very well, shade, everything that you really need to be a sustainable forester. In the middle, we have a forestry fund that we supported in Ireland. They buy up, again, rather, I wouldn't say poorly managed, non-managed, very often Sitka spruce or slightly mixed forest properties on previous agricultural land. They're often that have received afforestation subsidies. In these cases, very much the new owners are not foresters and have not treated them as forests. They just took the subsidies and just left them to just run wild. And so what they do is they go in and they thin it out, and then gradually converts these poorly managed forests into continuous cover forestry, which is also kind of close to nature forestry. But again, what they're doing really is they need to acquire these properties at a reasonably low cost, actually. But another way they make money really is by putting together many properties into a large portfolio which can be sold to institutional investors. Now that does two things. One, by building up a large portfolio, in a way the risk, for example, from wind throws or whatever, or disease, is reduced actually compared to single properties. So there's that kind of a diversification that reduces risk, and also the size itself just makes it more an investable object. And both things actually increase the valuation of these properties. And then finally, a small one, in Portugal, through Rewilding Europe Capital, you have a big problem of abandoned land. So you have absentee landowners, but where the public authorities have the right to lease this kind of communal land for good purposes. In this case, the local village here was under the fire risk from these undermanaged, non-managed forests, often with non-native species. And so it's kind of a social enterprise where they've gone in and made some initial say revenues from clearing the wrong kind of vegetation, and then basically introducing a variety of possible revenue streams. But what is just rather interesting to note is that, you know, while there are several financial reasons why this, I mentioned, for example, portfolio building, there's also the fact that continuous cover forestry, i.e. non-clear fell, gives a more stable cash flow. All good reasons why there's a financial rationale, but there's no way of getting around the fact that the way the entry point really for making money is that you acquire these properties at relatively cheaply, actually, well, as some say, market rebate, because ultimately a lot of the profit that's made from here, at least on the commercial side, is from the revaluations of these forests. Three examples from the water sector. So we, on the left side, this was a loan that we provided to a utility in Belgium. What's interesting here is that this was to install wastewater treatment in very small settlements. Why? Because the rivers needed to achieve a level of quality that was actually very, very high to enable the return of the pearl mussel. What this really meant was that they had to go way beyond compliance, right? The wastewater treatment directive requires, you know, treatment down to 2,000 person equivalents. By the way, this is being modified. There'll be much more strict requirements actually in future, but when this was done, it was still under the 2,000 rule. But they've gone down to much smaller settlements. So there was no legal requirement per se here. This was the owner of the utility, the Volund region, the utility and its customers basically being fine with it, that this goes on the tariff, and that the water company engages in this exercise. What it shows really is that even within what we think of the rather rigid area of public sector, there's still scope for talking to stakeholders and customers and doing something with a much higher level of ambition. We also financed some investments by the Paris Water Company. This was a broad range of nature investments. Interestingly, so the Paris Water Company has some very large above ground transmission lines for their water supply in these kind of aqueducts. And in fact, in some, what that's meant is that their infrastructure crisscross the city and the entire region, and also provide a kind of ecological connectivity, in fact. And so part of the project has been greening of these aqueducts and other linear infrastructure. But the key point here is that the utility has a real vested interest here in promoting the regional awareness and strategy and policy around biodiversity, because ultimately what is good for nature is good for catchments. So that core strategic link, added to which we tend to, sometimes when we talk about nature-based solutions in water supply, we immediately go to the workshop and think about constructed wetlands or ideas like that. But we tend to forget that the water sector exists in one giant natural water cycle. It is but a little parenthesis, and therefore the utility that is within that little parenthesis has every interest in making sure that everything outside that little parenthesis is being managed sustainably. And finally, of course, you know, customers viscerally associate wholesome water with nature. And we see that there are plenty of cases around the world where wastewater is effectively recycled, but it kind of still works psychologically because it's gone back to a river, or it's gone back to a lake, or it's gone back to some kind of infiltration or into an aquifer. But there's this huge psychological link between nature and water supply, in fact, that that means that water companies are often a very strong ally in this. Finally, in Italy, there's an example in northern Italy where a company called Etifor, who develops projects in MBS, started an EU Life project to effectively put funding for nature-based solutions in a drinking water protection area on the investment program of a water company, a multi-utility, and therefore on the customer tariffs. It might sound that might sound a bit obvious, but actually it's not. The Water Framework Directive, even though it has these notions of environmental and resource costs to be included in tariffs, it's not always been operationalized quite in that spirit. And what's interesting is that they managed to convince the water regulator to change their definitions precisely to allow this kind of investment to take place. Just a couple of more examples I think interesting. We talk about ecosystem services, and very often it comes across as a very esoteric, hard to value thing. Well, the region of Castilla-La Mancha has kind of turned it a bit on its head. They've created an alliance where say cities and corporates through a voluntary mechanism can fund management of forests, specifically catchments for water, areas of biodiversity, and so on. And the way this has been calculated is not through some esoteric valuation of nature or ecosystems, but simply what is the cost of managing those forests and those ecosystems so that they can continue to provide the desired services, if you will. And it's a very practical way of approaching this problem. And it sidesteps a lot of complicated economics, and people can immediately open the books and see what they're paying for, which is another advantage. The region of Lombardy has launched something called Bioclima. This is an interesting way of guiding corporate sponsorships, as it were. I mean, all around Europe, corporates are quite interested in funding forest projects or biodiversity or whatever. Now, from the public sector point of view, they would rather see all that CSR money going to some real purpose that they can use. And so Lombardy wanted to see if they could draw all this money into their Natura 2000 plans. And it's dead simple, really. So basically the region has come up with a co-funding, matching, say, subsidy mechanism, so that if a corporate wants to put down, say, 50,000, then they will put down another 50,000, and it gets tied to a specific forest certification according to FSC is done using their ecosystem protocol. So everyone knows what they're paying for and what they're getting, and it's just dead simple. It's an interesting way of providing a very simple means of private and public co-financing. You can look it up and see the details. Finally, one of our own. So we're currently trying to develop a peatland standard for Ireland, building on experiences from the UK. And you often hear that things like carbon credits or carbon offsetting or biodiversity offsetting should somehow be good for communities. That is a very easy thing to say. And what we're trying to do there is to build a combined concept that will capitalize, you might say, on corporate financing, on the carbon markets, and to translate that into something that has lasting value for biodiversity restoration and for regional development in communities. One interesting observation here has been that if you look at what it costs to restore peatlands, there's of course a wide range, a wildly wide range. And it turns out a lot of it can actually be restored for effectively below, say, the carbon tax equivalent abatement cost for CO2. And in fact, what that also means is that if you approach peatlands as a whole with that kind of spectrum, you can also adopt a kind of cross-subsidy and portfolio approach between the expensive areas to restore and the much cheaper areas to restore. So we're working with these concepts. There are many vested interests again around peatlands, energy, peatland cutting, which is now stopped, agriculture. So technically, you could probably write this on the back of a piece of paper. You could copy a standard from the UK, but the point is, it's a process where all these actors need to see themselves and feel that they're represented, but also that they, it's not going in favor of one of the other interests. It's taken us about 2-3 years, and we now have a broad coalition, and we've got various funding sources now to build this standard. Just finally, if you're looking for support for project development, I just mentioned two. I mean, if it's big enough, of course, at EIB, we're always interested in developing potentially bankable projects in this sector, but they have to have a certain size. And for us, really that starts at around 20 million. But for smaller projects, pretty much at the same source of funding, you can go to the Commission. If you look up SENIA and Green Assist, that is a technical assistance instrument for project development, but for smaller projects that might be of interest to you. I will stop there. I think that's enough. I look forward to any questions that you might have.
Thank you very much, Stephen. We have a lot of questions, and I'll be looking to Astrid to determine how much time we have to answer all these questions. I have taken down all the questions so far in the chat, and I'm going to try to move through them, not exactly one by one, because several people have asked about 10 questions. I want to make sure each person at least has one question addressed. So I start with...
I'm also happy to answer the questions in writing afterwards if you put them together.
Yeah, I'll be sending you the list of questions anyway.
Right.
All right, so the first question from Carrie Whalen. Please give an example of what are the quote unquote larger programs that you alluded to just now, of which nature or biodiversity considerations might be something very minor.
Well, typically when we're dealing with climate adaptation, we found that climate adaptation is actually a very good entry point to discuss nature investments. What starts off as a problem in people's mind, in a way creates a situation where they're very open to discussing what happens in that landscape. So, for example, most utility companies, by the way, have investment programs that have some natural biodiversity element. Even energy companies. Say most urban projects these days have some green components. Now, I haven't gone so much into that question because, from a nature restoration point of view, is perhaps not the most relevant, but certainly greening of cities is not a particularly hard sell these days, because basically people see a green city and they want one for themselves. So those are just a couple of examples.
Okay, the second question is from Pierre Catoire. When you say the NCFF was non-concessionary, how is this achieved through the EIB? What would need to happen for this to be replicated without public entities?
The NCFF itself, as I said, it was non-concessional, but we got say a certain risk coverage from the Commission. It's just that risk coverage didn't translate into a pricing advantage, because that wasn't the intention. The intention was to stick to commercial pricing. So, I mean, absolutely, I mean, in principle, a commercial entity could do this, but they would face similar challenges, which is you have to sift through a lot of projects to find something that works. So the demand, or say the opportunities for repayable nature projects is still not huge. It's better now than it was, mind you, I have to say. And what this implies really is that there are a lot of costs to be covered. You might need to subsidize the operations for this. It works better if it's within a specific sector like forestry, agriculture, where you have a specialization and it's more of a, say, cookie cutter, then it's more viable. But if you have a broad spectrum instrument like the NCFF, then you will run into that complexity and difficulty in covering your own costs, really.
The next question is Paolo Andres. Can you talk about the role of the EIB in enhancing mutual guarantee entities in providing guarantees to natural restoration projects that may have long-term returns?
Well, in a way, if you mean by so equity funds at least pool the risk, for example, then we can support social enterprises, cooperatives, and we do. So for example, in agriculture, for example, I mean that is quite possible. So the EIB in itself, as I said, will not provide specific risk coverage. What there are guarantee instruments that are available through, say, commercial banks that come from the Commission, that can be used for SMEs and cooperatives and so on. There aren't enough of those instruments, though, and they're not. Say the risk appetite isn't huge, right? What we can do, say, from EIB side, is provide long maturities if the borrower is of a sufficient credit rating. The longer the maturity, of course, the longer, say, the counterparty risk and regulatory risk. There are reasons why long money is not easy to come by. But yeah, I mean, long maturities for sure. We also have quite a lot of resources for project development that we can apply in such cases, which also might imply assisting the entry of other sources of finance, other finances. Yeah.
Okay, several more questions from Pierre Catoire. One is, first, what types of structuring were the most effective? SPVs? And I'll go after that with a second question.
Yeah. As you saw from one of the earlier slides, we actually managed to test a lot of different models. See, pure equity is, say, equity risk instruments are really what a lot of these, say, projects need. However, the traditional equity fund, closed-end equity fund, of course, even long funds are still only 10, 15 years. And they are looking for commercial returns usually. But as such, equity is a pretty good instrument, but it does run into the challenge that, say, nature projects are illiquid and traditional ownership can be a challenge. So the second, really the most suitable instrument for sharing risk really in this space is either guarantees or contingent loans. They've got lots of different names, lots of profit participation loans, whatever, where you're sharing risk. So it's almost like equity risk, but you're not getting ownership, which can sometimes be a real problem in the nature sector. But obviously, you know, otherwise standard banking applies, right? You know, if it's a company with a decent sized balance sheet and track record, or a public sector entity, I mean, they're always very welcome also as intermediaries, even for projects. Utilities are perfect.
The next question from Pierre Catoire is, which types of aggregators/financing relays were the most open to the conversation, even if it didn't lead to any investment decisions?
Yeah. So we actually surveyed about 200 banks, and basically the finding was that most of them are still grappling with climate. They haven't even got their head around nature, with about 3 or 4 exceptions. So you have some institutions like Triodos, like BNP Paribas, Rabobank, who in a way moved on this sector early, maybe not as early as we did, but some years ago, and they've already cut their teeth, and they've stuck it out, right? They've got up again and tried again, and they've really learned some important lessons. So there are some, say, financial intermediaries out there who are switched on and motivated, but it's not easy for them. Commercial banks, they'll have a nature project once in a blue moon. So the conversation that they're meeting first is rather than investing in nature, it's more becoming aware of nature-related risks, and there's this whole debate going on. And same with many corporates too. That the first step is often that they become aware of their supply chain risk, for example.
You may have answered this. There's a follow-up question you may have just answered from Pierre Catois. What made an aggregator slash financing relay capable of packaging portfolios?
I would say it's that they internally allow the time and attention and money to do this. Now, if we also take equity funds, for example, as aggregators, so the viable equity funds, as I said, they tend to specialize. Then it could be, say, forestry, for example, and what you will want there are, well, some people who have some serious experience as forestry, as foresters really, and in investing, and understand the concept of returns and making money for their investors, right? So that whole track record issue is a very personal thing. It's not enough that the institution itself, is willing or has experience. You're really down to people level to see if they're the right people to engage and develop this and manage your money. I said banks are different though. I mean, commercial banks are not necessarily say a novel financing instrument is not going to drive an aggregator into suddenly going into a new area. Rather, it's the other way around. You're trying to look for aggregators, banks, whatever, who are already making an effort looking at a sector but want to go a step further, and then with your resources they can, say, increase their so-called firepower, as they say.
The next question is from Wen-Ting Chen. What scale of projects does the normal banking normal banking financing looking for, usually to make restoration project more effective in terms of impact on an ecosystem and biodiversity? Large scale is needed.
Well, I mean, provided that it is bankable, then above 10 million for, say, most say impact style investors, I would say. Above 50, above 30 for institutional investors.
Okay, the next
Yeah.
question is from Paolo Andres. You are constantly mentioning the risk issues and the need of de-risking them.
Yeah.
Which suggestions could you provide to restoration project managers to de-risk their projects?
In actual fact, when it comes to nature restoration, it's not so much, in the first instance, I said the risk element is there a revenue stream at all? That is the funding side, as I mentioned. That's the first hurdle to cross. And once you can answer that question, you're sort of more ready maybe to talk to an investor looking for repayable finance. But in terms of how you would de-risk, on the finances side, of course, they can try to get a guarantee or they work with likes of us or whatever. But I mean, on the promoter side, the project side, the traditional banking relevance techniques apply, which is, you can either get someone to guarantee you, or you can be, say, subsumed under some corporate balance sheet or a public balance sheet. You can get offtake. You have reliable agreements with off-takers for whatever revenues there are, or you can create them. I mean, I mentioned sort of ecosystem services. Most of the innovative projects are really where quite different entities try to get together and try to hash out some kind of an agreement regarding restoration versus benefits accruing to some party. So, for example, forestation around dams to avoid siltation. So between, say, land managers and the dam operator, all these things happen. But clearly, it helps to have a very thoroughly worked out proposal. But from a pure banking point of view, you really do need some traditional banking relevant parameters, which is a counterpart that has a track record, has a certain size, has other revenues perhaps that can cover shortfalls. Yeah.
Related question from Pierre Catoire. When we look at de-risking versus risk return, do you see the just transition mechanism as an example of structure, if adapted to NBS, to unlock at least some investments, maybe mostly from insurance and reinsurance?
Okay, well, the just transition mechanism consists of a number of components. I mean, you have it. One is as a guarantee, you might say, for lending, and the other one is also a grant component. So how exactly that will relate to insurance and reinsurance? So insurance and reinsurance make their money on premiums, and they are fundamentally short-term premiums. Right, you can't insure long. You can't insure things for 10 years typically. It's usually an annual premium. So per se, the insurance companies will price the risk as it needs to be. But when that risk becomes systemic, so meaning that when that house goes, they all go, then the traditional insurance model breaks down or insurance becomes unaffordable. So yes, I mean, financing climate adaptation, for example, at scale to protect communities can make them insurable, put it that way. So yeah, you can create synergies there. In principle, insurance companies can also act as investors, of course. That is slightly rarer. So I would make that company that way. I mean, there's a lot of dimensions to that question, but the insurance business is concerned that they will need to radically change their business model if they're to remain relevant, say in a climate impaired world, put that way.
A similar on this again on de-risking from Pierre Catoire. There is also the risk related to inaction on the macro scale. Is this part of the investor's criteria?
Well, see, most investors will try to avoid risk in the first place. That is actually the first action that often happens. so we expect some, all these stakeholders to kind of go into these questions and complexities and try to manage these risks. But actually, as long as there's an easier way of making money somewhere else, that's pretty much where they will go. Can you repeat the question again?
Surely. On the de-risking topic,
Yeah.
there is also the risk related to inaction on a
Yes.
macro scale. Is this part of the
Yeah.
investor's criteria?
Yeah. I mean, I would say, whenever we go in, where we go into a project, and most investors go into a project, and if they are looking for some element of climate proofing, so we are looking down the line, what's going to happen. And so if certain risks are not dealt with, then we will not finance these projects or go into certain areas. We will require at least that climate risk and vulnerability assessments, for example, are conducted and relative certain actions take place. But yeah, I mean, investor behavior is a bit funny. We're different because we're a public institution, so we don't. Our mandate is not to go where it's easy necessarily.
This next question is from Gerardo Anzaldúa. I think the concept of environmental and resource costs in the Water Framework Directive is one concrete handle that could be used to finally drive private funds into dealing with nature conservation and restoration. Not from the viewpoint of generating a return, that's already there from the use of the ecosystem services that enable the business to operate in the first place, but from that of compensating for the use of the resources. What do you think it would take to get this going? What was the leverage point that allowed the ETIFOR to do that in the example that you mentioned?
Yeah. First of all, I think the immediate cost implications were relatively modest. I think if they'd asked for 10 million first, that might have been a challenge, but they asked for 1 to begin with. Well, if you actually implemented the Water Framework Directive as it's written, we wouldn't have a problem today. But it hasn't been. So I think that's the first question. And a lot of it has to do with that even though you have these provisions, tariffs are still under political capture. And by the way, I'm not, I'm not necessarily always advocating a very square approach to tariffs. I think cross-subsidization makes sense in many cases, but I think there have been different schools of thought around how these things should be calculated, and for a long time, I think there was the dominating voice was, what is the price of water, and a lot of complicated economics. What they did in the case of ETIFOR was really to build the case from the bottom up. They said, okay, we have a basin here and it has certain objectives in terms of what do we want it to do in terms of water quality, water quality, quantity, recreation, biodiversity, whatever. What will it take to be able to maintain that? And let's assign costs and responsibilities to these actions and then ask. So it was very much a bottom-up model. What does it cost to manage this thing within this regulatory cycle? Because we don't know everything. This is our best estimate for the next 4 years. That's a very concrete basis to work on. The other approach, which is much more esoteric and try to create water markets or kind of proxies, for what's the value of water, it's just a way of not achieving anything for 10 years. And by the way, you're not assigning specific responsibilities and actions and costs. So the ETIFOR model was actually very tangible, and I think that must have been comforting for the regulator. Plus, as I said, so initially and the other thing, by the way, because as I said, ultimately, this whole business of funding, and willingness to pay, you're trying to sell this idea to someone. And what they did was the measures they they introduced in this drinking water protection area were, say, nature-based solutions. What does this mean? It means that there were co-benefits. There was never only just one winner, but several winners. And the general willingness to pay in the population was very, very high for those kind of measures. So it made it easier for the regulator also to put it on the tariff.
Another question from Pierre Catois. How
Yeah.
was each project's theory of change designed, and was the EIB involved in each decision for your 11 investment examples?
Well, the only thing we decided on in the end, of course, was whether or not we would finance it or not. And I have to say that half of the promoters, the successful promoters, I mean, were heroes, often defying their own health and market logic very often. But yes, I mean, we occasionally, technical assistance from our side, proved to be an interesting carrot. Also in terms of, say, covering, say, certain transaction costs, but also because we had a joint interest in monitoring these things, the outcomes. So a lot of our TA revolved around better measurement, you might say, was happening. In the case of CDC biodiversity, it was actually biodiversity credits, right, under French law. We haven't talked about that, but it's an interesting topic that's come on board now. Yeah.
A question from Wen-Ting Chen. He gives this investfornature.eu/project. We are trying to develop a SCBA calculation tool and suggesting financing mechanism and business models. Will that help small-scale private investors?
Perhaps someone could explain what SCBA. I know what CBA is, but an SCBA?
Yeah, I don't know if Wenting is here. I can't.
Yeah, I can just jump in. The social cost benefit analysis, much more like including the societal benefits, for example, the
Okay. This is music to my ears. Okay, so one of the problems we face with nature finance is that it's so linked to landscapes and climate mitigation and adaptation, right? And risks, some of them unexpressed. And unfortunately, there's a lot of complacency in all these areas. And we know the complacency on mitigation, but the complacency on adaptation is also there. People are simply living in very unsafe places and not doing anything about it. So what can you do? I mean, really, our first job very often is simply to just try to sensitize people, to bring to people's attention that there is an issue that needs to be dealt with. And when we look at the tools that we normally use for our projects, things like CBAs or climate risk and vulnerability assessments and so on, so on, they're all very, very technocratic. They're basically for an audience of one, which is some person in a ministry somewhere deciding on a grant or something, right? They have not been built as tools to really build consensus and to communicate with people. Just one very basic example. I mean, a lot of when we talk about these risks, for example, we talk about return, like a 20-year return period. This is not something that human beings can naturally understand. We are more into totems and magic and magical thinking and so on, so on. When we think about risks and benefits, our brains just don't comprehend these concepts. And yet, this is the language we're trying to use to convince people to act or to pay for things. So a lot of it is that we also need to depart from the very technical way we do our CBAs. We need to be looking at the secondary impacts that speak to people. When you have a flooding, it's not just houses, it's homes, it's families, it's post-traumatic stress. It could be all sorts of, negative economic spiral happening in the region. I mean, we really need to develop those tools. Frankly, if you know anyone out there who's an expert in this? I need one.
The next question is from Mohammed Umar Farouk. Can we have risk mitigation like conventional finances? Insurance or hedge funds can be required to add a % of green projects in their portfolio, other than renewable energy, nature-based projects.
Yeah. So I mentioned I took the name of institutional investors in vain a bit earlier, saying that they don't want risk, they don't want hard work. That isn't entirely their own fault. It's actually like current regulations mean that institutional investors are bound to choosing rather boring, safe things like public equities, shares, fairly low risk infrastructure projects, and so on. Yes, I mean there needs to be perhaps a relaxation of some of those requirements on institutional investors. That would help. And the regulation can do a lot of things within the bounds of reason. And so the concept of nature positive, for example, it hasn't really got a proper definition yet, but we kind of get what it means, which is we should be talking to our promoters about what they can do more. And that ties a bit into this whole business of credits too. I mean, credits are ultimately just a way of communicating to people that this is something that are they potentially interested in this, or and what are they getting, in terms of permanence, integrity, and so on. So yeah, I think with some regulatory tweaking, you could really at least multiply the current trickle to a small stream at least.
Yeah. The next, and I believe final question, because we are running out of time, is from Gerardo Anzaldúa. If projects tend to be small in scale, and the investors that would be more leaning towards them are often associated with smaller volumes too, for example, small impact investors, crowdfunders, is that telling something about the direction we should be looking at?
I would say small isn't necessarily always a particularly good indicator of impact. So small can definitely also be high impact, and small can also be transformative. It can convince other people, neighbors, to go down the same path, for example. Well, as I mentioned, right now the biggest unmet demand are among these small projects, and they're small not even in relative terms. It's just that when in the nature space, it just isn't very capex intensive. Even a small bridge probably costs a lot more than a large forest. That's the thing. So yeah, you have impact investors who are interested in these projects, and I guess the question is, what could one do to help them? I think the one area in which even impact investors run out of steam is often in the project development phase. That there is actually a limit to how much time they can spend on working with a proposal in a landscape. And often these are complex stakeholder processes. Sometimes it even includes public authorities. They move on a somewhat different time, and a lot of them will just run out of patience and money before they reach the end. So I think that's an area where we can support. But as I said, what we do need though will be a kind of NCFF, but for even smaller projects, and more have a much higher risk appetite and be largely concessional, somehow dovetailing with the grant ecosystem. That is the big need now. And by the way, that would also help in landscapes, because landscapes are also made of smaller ventures. So yeah.
So we should start bringing this to a close now. Thank you very, very much, not only for an excellent presentation, but for generally going about twice as long and answering questions as I've ever seen, a marathon performance. Thank you so much. I would like to briefly announce there will be the next seminar the first week of December. The University of Dundee's Chris Spray will be talking about the Edelston Water Project, what has worked, and what we've learned about natural flood management and how to deliver it. This has been recorded and will be available on the MERLIN website. I'm going to pass on the questions. There are a couple of more, but really at an hour and a half, we're well over our time limit, and we really have to draw this to a close. So thank you for excellent webinar.
Thank you for letting me join.
Thank you also from my side, Stephen. It was very interesting. Also in the chat, many people wrote this, that they thank you for this interesting insights.
Thank you.
Stephen, if you could send me any more information about the Macá River project in Portugal, because I am working on a project on reducing wildfire risk, and rewilding in Portugal is one of our example projects. So I'm very interested in how they're funding that.
Okay.
I'd
Well,
appreciate
we'll
it.
be in touch. We'll be in
Thank you
touch.
very much.
All right. Thank you.
Right.
Bye for now.